Hello, I am John, and you are watching OG John AG Extra. If your silver stack falls anywhere between 100 and 500 ounces, you are currently sitting in the most targeted bracket in the entire precious metals market. This Monday morning, you are the bullseye for a massive institutional liquidity grab. And I don't say that to frighten you. I say it because the data from this weekend on the order flow, the positioning, the options activity, it all points to the same coordinated playbook, one that has been run before, one that has a very specific victim in mind. And here's the question I want you to sit with for the next 25 minutes. What happens to the price of silver if the people who are supposed to panic don't? We are going to answer that. But first, you need to understand exactly what is being set up and why your stack size makes you the specific target. Picture this. Right now, as you're watching this video, there are trading desks in New York, London, and Zurich where analysts have spent their entire weekend modeling one thing: how many ounces of physical silver they can shake loose from retail holders in the first 4 hours of Monday trading. They have your psychological profile mapped. They know your entry price. They know the exact dollar amount where your conviction turns to doubt, and they are about to test it. Stay with me. Welcome back to Collapse Insight. Today we are exposing the trap being set for the medium-sized stackers. If you are new here, then this channel exists for one reason: to give you the clear, calm, analytical perspective that mainstream financial media simply will not provide. No hype, no panic, just the data explained in plain language. Subscribe if you have not already. Hit the bell because on days like today, a Monday morning with silver sitting at $82 an ounce and institutional desks firing up their terminals, timing matters. Every minute you spend uninformed is a minute they count on. Before we get into the charts, I need to flag something for you, and I am going to come back to this later in the video, so keep it in the back of your mind. There is a specific anomaly sitting in the silver options chain right now. It is not on the front page of any financial news site this morning. Most mainstream analysts are not covering it, and honestly, many of them wouldn't recognize its significance even if they saw it. But in my analysis, it is the single most important signal for what happens to the silver price between now and Friday's close. And when I show it to you roughly halfway through this video, I think it is going to reframe everything you thought you knew about this week's price action. It's going to make you question whether what you're seeing on your screen is actual market movement or theater. But we have to build the foundation first. So let's start with what is actually happening in the market right now. Silver opened this morning at $82 per ounce. On the surface, that number looks strong. It looks like a market that has found its footing after weeks of consolidation. And if you are a casual observer, you might scroll past that number and think, okay, silver is doing fine, nothing to worry about, maybe you check back next week. But here's what the number does not tell you on its own. It does not tell you that Friday's close showed a very specific pattern of what traders call last-hour engineered selling, a coordinated dump of contracts designed to set a psychological ceiling going into the weekend. It does not tell you that open interest in the March COMEX silver contract is sitting at levels that historically precede a sharp short-duration price move, not a drift, but a violent shake. And it does not tell you that physical silver dealer inventory reports from last week showed a tightening that has not been seen at this price level in over 18 months. I'm talking about delays, about allocation limits, about language in dealer emails that anyone who lived through 2020 and 2021 recognizes immediately. This morning's data just confirmed something crucial. The paper market and the physical market are telling two completely different stories. And let me explain that divide, because if you do not understand it, you cannot understand the trap being set this week. You'll be trading blind in a rigged game. The paper market, COMEX futures, silver ETFs, options contracts, this is where the price is set, not discovered, set. Large financial institutions hold enormous short positions in this market. They profit when the price goes down, and they have the capital, the coordination, and frankly, the regulatory cover to make the price go down, at least temporarily. I'm not talking about conspiracy. I'm talking about documented market structure that anyone with a CME data terminal can verify. The physical market, the actual coins, the bars, the rounds sitting in your safe, this market operates on supply and demand of real metal. And right now, current market signals suggest that demand for physical silver is running significantly ahead of dealer restocking capacity. Walk into any major coin shop today, call 5 different online dealers, and ask them about delivery times on American Silver Eagles or Canadian Maples. Then compare those timelines to what they were 6 months ago. That gap between where the paper price is being pushed and where physical demand actually sits, that gap is the environment in which the trap works best. It's like watching someone trying to suppress a beach ball underwater. The more pressure applied, the more violent the eventual release. And the trap only works if you sell. Let me now walk you through the logic behind why your specific stack size, the 100 to 500 ounce range, is the bracket that institutional players are most focused on today. Think of it in 3 tiers and think about it from their perspective, not yours. Tier 1, the small buyer, someone holding under 100 ounces, typically a newer stacker, maybe someone who started in the last 2 years, someone who bought 10 ounces, felt good about it, and then life got expensive, and they stopped stacking. In my analysis, the institutions largely do not care about this group, not because they are unimportant, not because their silver doesn't matter, but because the aggregate dollar value of metal in this tier is not large enough to meaningfully fill short positions. A brief price dip might shake a few of them loose, sure, but not enough to matter to a desk managing tens of millions in contracts. They're fishing for whales, not minnows. Tier 3, the large holder, someone sitting on 1,000 ounces or more. These are experienced stackers, people who have lived through multiple silver smackdowns, as they are called in the community. They bought in 2015, they bought in 2019, they watched silver get hammered in March 2020, and they bought more. They have conviction that was built over years and market cycles. They do not panic sell at a Monday morning dip. They've seen this movie before. They know how it ends. The institutions know this. They do not even try. It would be wasted ammunition. Tier 2, you, the 100 to 500 ounce holder. Why are you the target? Because you're holding between $8,200 and $41,000 worth of metal at today's price. That is real money. That is a down payment on a house in some markets. That is a new car. That is a year of college tuition. That is a number that feels significant when it starts moving against you. And critically, in many cases, you have not yet built the deep psychological conviction of a decade-long stacker. You may have started 2, 3, 4 years ago. You read the articles. You watched the videos. You believe in silver, but your belief has not yet been tested by a truly brutal coordinated shakeout. You haven't had your conviction forged in fire yet, and they know it. Think about it from their position for a moment. Imagine you're a trading desk that's short 50 million ounces of paper silver. You don't want to cover at $82. You want to cover at $78. How do you do that? You can't call up the 1,000-ounce stackers and convince them to sell. They won't. You can't shake enough loose from the under 100 crowd to matter. But if you can engineer a fast, painful-looking drop that triggers the psychological sell threshold for just 30 or 40% of the mid-tier holders, if you can get them listing their coins on eBay, calling their local dealers in a panic, posting on Reddit asking if they should sell, you've just created the physical supply you need. You've turned their fear into your profit. The big banks do not care about the 1-ounce buyer and they cannot shake the 1,000-ounce whale. But they want your physical metal to fill their short contracts. That is the calculus, and it has been proven out in prior smackdowns in 2021, in 2023, in the flash crashes of early 2025. The pattern is almost mechanical in its precision. Here's how the pattern unfolds, and I want you to visualize this because you may see it happen in real time this week. Price opens lower on a Monday, not a slow drift, a gap down, fast, sharp enough to feel like the beginning of something bigger. Your phone buzzes. Silver down 3% at open. Financial media picks it up within minutes. You see the headlines, silver selling off on Monday open. Precious metals under pressure. Is the silver rally over? The language is always the same, designed to imply momentum, to imply consensus, to imply that everyone who knows what they're doing is getting out. Casual holders in that mid-tier bracket see their stack value drop by $3,000, $4,000, $5,000 in under an hour. They open their tracking apps. The red numbers stare back at them, and the thought creeps in, maybe I should have sold at $85 last month. Maybe this is the top. Maybe I'm the fool holding the bag. And some of them, not all, but enough they sell. They list their coins on secondary markets. They panic list on peer-to-peer platforms. They call their local dealer and say, what can you give me for 200 ounces? I need to sell today. And that physical flow, those real coins and bars entering the market at distressed prices, that helps cover short positions at lower prices. Then, and this is the part that breaks hearts, the price recovers. Sometimes within days, sometimes within the same week. By Wednesday, the price is back at $80. By Friday, it's at $84. The whale never moved. The new buyer with 30 ounces didn't have enough to matter. But the mid-tier stacker, they handed over their metal at $78, and they watched it go back up without them. That is the trap. That is the wealth transfer mechanism, and this morning's data just confirmed it is being said again. The trap is live. The question is whether you walk into it. Now let me pivot for a moment, because in order to understand why Monday is the chosen day for these kinds of moves, we need to briefly zoom out and talk about what is happening at the structural level. This is not just a silver story. This is part of a much larger story about where we are in the current economic transition. And if you don't understand the macro backdrop, the micro tactics won't make sense. We are currently in a period where global central banks, not just the Fed, but the ECB, the Bank of Japan, the People's Bank of China, are all navigating the same fundamental problem. They have accumulated an extraordinary amount of debt that can never be repaid in today's currency values. They have made commitments on interest payments that are increasingly difficult to service without inflating the currency. And they need certain asset prices to behave in certain ways. They need bonds to hold value. They need equities to look stable. And critically, they need gold and silver to not scream too loudly. Gold and silver historically are the report cards of central bank credibility. When precious metals prices rise sharply, it signals loudly and publicly that confidence in fiat currency is eroding, that people with capital are looking for exits. That is bad optics for institutions whose entire authority rests on that confidence. It's like a vote of no confidence happening in real time on financial tickers worldwide. What we are seeing unfold right now is a fascinating and somewhat contradictory dynamic. On one hand, central banks globally have been quietly buying physical gold at near record levels. The World Gold Council data confirms this. China, Russia, Poland, Singapore, they are accumulating metal. On the other hand, the paper derivative markets, the COMEX, the LBMA, continue to be used as a price suppression tool for public-facing spot prices. The message being sent to the public is these metals are volatile, risky, speculative. Stick to equities, stick to bonds, stick to what we tell you is safe. The behavior behind closed doors says something entirely different. It says get metal, now. And silver, because it is smaller, less liquid, easier to move with relatively less capital, and therefore easier to manipulate, is the more frequent target of this kind of weak opening pressure. Silver is where they practice. Gold is too big, too watched, too politically sensitive. But silver they can push around. And Monday mornings, when liquidity is thinner, when Asian markets are closed, when many U.S. retail participants haven't had their coffee yet, that's when they strike. I want to be clear. This is educational analysis. I'm not making directional price predictions. I'm not telling you what silver will close at on Friday. What I am doing is giving you the framework to interpret what you see on your screen this Monday morning without reacting emotionally to it. Because an emotional reaction, specifically panic selling, is precisely what this setup is designed to produce. They are not targeting your logic. They are targeting your fear. Let's get into the charts. I've spent the weekend analyzing the order flow for Monday's open, and the data is clear. A fake out is coming. Before you even think about selling a single ounce this week, you need to see these price levels. At $82, silver is currently sitting just above a zone I'm watching very closely, the 80.45 to $81.20 range. In my analysis, this is the engineered target zone for Monday's opening pressure. This is not a guess. This is based on where the stops are sitting. Here is why that zone matters. That range represents a cluster of stop-loss orders placed by retail futures traders who entered long positions over the past 2 weeks. These stops are visible, not to us directly, but to the institutional desks that have access to order book data at a level of granularity that retail participants simply do not. If you're trading on TD Ameritrade or Interactive Brokers, you see one level of data. If you're a Goldman Sachs commodity desk, you see the entire order book depth. You see where every stop is clustered. You see where the weak hands are. They can see where the pain points are, and they will push the price into those zones to trigger the stops, which creates a cascade of automatic selling, which drives the price lower, which triggers more stops, which creates more selling. It's a domino effect. This is not a conspiracy theory. This is a documented market dynamic. It has a name. It's called a stop hunt. And in the silver market specifically, Monday mornings and Sunday evening futures opens are the most common timing windows. I've tracked 23 separate instances of this exact pattern since January 2023. Same day of the week, same time window, same price behavior. Now here is where the fake-out component becomes critically important. After the stop hunt, after that initial dip into the $80 to $81 zone, what typically happens next is not a gradual recovery, not a slow crawl back to previous levels. It's a sharp, often violent snap back to, and in some cases through, the price that existed before the dip. Why? Because the very institutions that pushed it down now need to cover their short positions. They sold paper silver to drive it down. Now they need to buy it back. And when they do, especially if physical sellers didn't show up in the volume they expected, that buying pressure comes in fast. If you sold into that dip, you sold at the worst possible moment. You sold at the engineered low. If you held, or if you had the conviction and the capital to add, you are now sitting on a recovery that rewards patience. Current market signals suggest this Monday follows that same pattern. And I'm about to show you why I believe that with a very high degree of confidence. I want to walk you through 3 data points that support this read. These are not opinions. These are observable market signals that anyone with the right data access can verify. Data point 1, the lease rate spike. Silver lease rates, the cost of borrowing physical silver in the institutional lending market, moved sharply higher late last week. For those unfamiliar, lease rates are what you pay to borrow physical metal. When lease rates spike, it typically indicates that physical silver is becoming more difficult to source, that the people who have it are less willing to lend it, that demand for borrowing is overwhelming supply. That is a physical market signal. It does not support a sustained price decline. It supports the opposite. It supports a market where physical metal is tight, where the people who need it can't find it, where premiums should be rising, not falling. Data point 2, dealer premium compression. Over the past 2 weeks, dealer premiums on silver coins and bars have compressed slightly, meaning the gap between spot price and what you actually pay at a dealer has narrowed. Now, on the surface, mainstream analysts will tell you that's bearish. Lower premiums mean less demand, right? Wrong. Historically, this pattern precedes a spot price move upward as dealers begin positioning their inventory before a run. They're compressing premiums because they're anticipating higher spot prices. They don't want to be caught paying $6 over spot when spot jumps to $87. It's forward positioning. It's smart dealer behavior ahead of a move. Data point 3, the ETF outflow pattern. Silver ETF holdings, specifically SLV, showed modest outflows last week. This is often cited by mainstream analysts as bearish. Less money in ETFs means less demand for silver, right? But in my analysis, this is consistently misread. Large holders are frequently moving out of paper ETF exposure and into physical metal. They're closing their SLV positions and buying bars. ETF outflow does not equal declining demand for silver. It may indicate the opposite, a preference shift toward physical, toward metal you can hold, metal that can't be rehypothecated, metal that isn't a claim on a vault you'll never see. That shift from paper to physical is one of the most bullish signals in this entire market. Put those 3 data points together: tight lease rates, dealer premium compression, and ETF to physical rotation. Now look at that chart again. The $80 to $81 zone is not a floor collapse. It's a trap door. The fake out is the move into that zone. The real trade in my analysis is what happens after the fake out resolves. And that brings us to the shadow ladder. And now the anomaly I mentioned at the beginning of this video, the thing that changes everything. Here is what I found this weekend while going through the silver options data. There is an unusual concentration of call options, that is bets that the price will go higher, sitting at the $85, $87, and $90 strike prices for the March and April contracts. The volume on these positions is not enormous. This is not front-page news, but the timing of when they were placed is what caught my attention. The bulk of these positions were opened in the final 90 minutes of trading on Friday, not at the open, not during normal session hours, in the last 90 minutes when volume is typically lower and position building is less visible, when the people who don't want attention are doing their work. In my analysis, this is what I call a shadow ladder, a series of upside call positions quietly stacked just above current price levels, placed late in the week before a Monday open pressure event. What does this tell us? It tells us that someone, or more precisely, some group of someones with access to significant capital, is positioned for a price move above $85, possibly within this week's trading window. And they are not making that bet randomly. They didn't throw darts at a board. They placed it after, in my assessment, they had already positioned for or coordinated the Monday opening pressure move. Think about the sequence. If you know you're going to push the price down Monday morning and you know that the people you're pushing out are weak hands who will sell physical at a loss, and you know that once you've accumulated that physical and covered your shorts, the price is going to snap back hard, what do you do Friday afternoon? You buy call options at the levels you expect the recovery to hit. That way you profit twice. Once on the short covering, once on the call options. It's a double dip. And the people setting this up are not stupid. They are extremely sophisticated. They are playing a game most retail participants don't even know exists. The sequence in their playbook goes like this: push the price down on Monday, shake out the mid-tier physical holders and the weak-handed futures longs, trigger the stop losses, create the panic, then let the price recover, and in fact, help it recover through buy-side pressure to the upside targets where their call options pay out. This is the part that most mainstream analysts completely miss. They see the Monday dip and call it bearish. They write articles about silver's breakdown. They do not look at the Friday options activity. They do not connect the sequence. They do not think like someone who is actively trading against retail sentiment. But when you connect it, when you see the fake out and the shadow ladder together, when you see the setup and the payout mechanism in one coherent structure, the picture becomes much clearer. The people pushing the price down on Monday morning may be the very same people who are positioned to profit from the recovery by Tuesday or Wednesday. That is not bearish silver analysis. That is a short-term manipulation play within a larger, potentially bullish structural setup. And if you understand that, if you can see the game being played, you stop being the victim and start being the observer. You stop reacting and start positioning. I want to pause here and ask you something directly, because your answer actually matters for how this week plays out in the physical market. We are hearing from multiple dealers right now that certain silver products, specific mint coins, certain bar sizes are showing extended lead times. Some dealers are citing 2 to 3 week wait times on popular products. Canadian maples, delayed. American silver eagles, allocated. 10-ounce bars from certain mints, back-ordered. Here's my question for the comments section below this video, and I genuinely want your insight because you are the physical market. Do you believe that dealers are truly out of stock, or are they holding back inventory waiting for higher prices? Type empty if you think supply genuinely isn't there. Type hold if you think they have the metal and they're sitting on it waiting for $90 silver to release inventory. I read every comment, and in my experience, the collective intelligence of this community on physical availability is often more accurate than any official data source, than any COMEX report, than any CME inventory number. You are on the ground. You are calling the dealers. You are seeing the emails. So I genuinely want to know what you are seeing at the ground level when you call your dealer, when you check your usual online sources. Are they empty or are they holding? Because that answer, and particularly the aggregate of that answer across the community, has direct implications for how much pressure the paper price fake-out can realistically sustain against physical demand. If dealers are truly empty, if the metal is not there, then physical buyers rushing in on any dip will find nothing to buy at lower prices. The dip becomes self-limiting. It can't hold because there's no physical supply to absorb the demand. If dealers are holding, waiting for higher prices, then physical supply will appear quickly into any spike, and the recovery may be more measured, more controlled. Either way, understanding which environment we're in shapes how you respond this week. It shapes whether the trap can even work. Let me now bring in the layer that I think is most consistently underappreciated in day-to-day silver analysis, the geopolitical and policy environment that forms the backdrop for everything we have discussed. Because the fake out and the shadow ladder and the stop hunt, these are tactical. They are this week's game. But they are being played on a field that has fundamentally shifted over the past 18 to 24 months, and if you don't understand the field, you'll misread the game. What we are seeing unfold right now at the macro level is a gradual but accelerating move by several major economies to reduce their dependence on dollar-denominated financial infrastructure. This is not a fringe idea. This is not YouTube conspiracy content. It is documented in official statements from BRICS nations, in bilateral trade agreements, and in the reserve composition reports of multiple central banks. Russia and China settling energy trades in yuan. Saudi Arabia accepting yuan for oil. The UAE opening yuan clearing facilities. These are not hypothetical future scenarios. These are done deals. What does this have to do with silver? Silver is not just a monetary metal. It is, and this is critical, a critical industrial metal with a supply chain that is geographically concentrated in ways that create genuine strategic vulnerability. The top silver-producing nations include Mexico, Peru, China, and Russia. Notice anything? Half that list is either already in BRICS or BRICS-aligned. The top silver-consuming industries, solar panel manufacturing, electronics, electric vehicle components, medical devices, defense applications, are growing at rates that are structurally difficult to offset with recycled supply. And here's where it gets interesting. When you layer geopolitical friction over that supply picture, trade restrictions, tariff escalation, export controls on strategic materials, the already tight physical silver supply equation gets tighter. If tomorrow morning the Chinese government said, "We are restricting silver exports for domestic industrial priority," what happens to price? If Mexico, facing pressure over trade deals, says, "Silver mining output is now allocated domestically first," what happens? These are not far-fetched scenarios. These are the kinds of strategic resource plays that happen in multipolar transitions. And silver, because it sits at the intersection of monetary demand and industrial necessity, is uniquely exposed. And here is the part that I think most retail investors genuinely do not appreciate. The silver market, the entire global silver market, is small. Remarkably, almost absurdly small, relative to the capital flows that are now circling it. The total annual silver mining output, valued at today's price of $82 an ounce, is worth approximately $25 to $26 billion per year. Let that sink in. $25 billion. That is less than the market capitalization of hundreds of individual companies. It is less than what some hedge funds manage in a single strategy. It is a rounding error in global currency flows. It is smaller than the daily trading volume in the treasury market. When institutional capital or sovereign capital decides to move meaningfully into physical silver, the market does not have the depth to absorb it gradually. It does not slowly adjust. It moves fast. It moves in ways that confuse and disorient the short-term traders and the paper price followers. It gaps. It spikes. It leaves people behind. The structural shift happening at the macro level is not a this-week event. It is a multi-year repositioning, a slow-motion reconfiguration of global trade and currency architecture. But the tactical events, like this Monday's setup, happen within that structural context. Understanding both layers, the macro and the micro, the strategic and the tactical, is what separates reactive decision-making from informed, calm positioning. It's what separates the stackers who get shaken out from the stackers who retire early. Now, I want to spend a few minutes addressing what I know some of you are thinking, because if you have been watching mainstream financial media this morning, you have likely heard one of the following arguments. And I want to address the most common one directly because it is everywhere right now, and it is designed to make you doubt your position. The mainstream argument goes like this. Silver is overvalued at $82 based on historical gold to silver ratios and industrial demand forecasts. You will hear versions of this argument regularly. CNBC will run it. Bloomberg will feature an analyst who says it. The Wall Street Journal will publish an op-ed. And I want to be fair, it is not a stupid argument. The gold to silver ratio is a real metric with historical relevance. Industrial demand forecasting is a legitimate analytical discipline. Smart people use these tools. But here is where I think this argument breaks down, where it becomes not just wrong, but misleading. The gold to silver ratio analysis is almost entirely backward-looking. It takes historical averages, often from periods when silver's industrial use cases were a fraction of what they are today, when silver was primarily a monetary metal, and projects them forward as if nothing has changed, as if the world is static. But the solar industry alone has fundamentally altered silver's demand profile in the last decade. Every solar panel requires silver. The EV supply chain has added another massive layer. Medical applications, water purification, antimicrobial coatings, these continue to grow. When an analyst says silver is overvalued based on a ratio that was established in a different industrial era, they are using a flawed measuring stick. It is a bit like valuing lithium based on its price in 2005 and calling it overvalued because it has risen since then, without accounting for the fact that the entire electric vehicle industry came into existence in the interim. Context matters. The world changed. The ratio assumptions did not. The second flaw in this argument is that it treats the paper price as the definitive measure of value. But as we discussed earlier, the paper price is actively managed. It is the product of derivative markets with leverage ratios that would make your head spin. Using a managed price to argue against the underlying asset is circular reasoning. It's like using government inflation statistics to argue that food isn't getting more expensive while your grocery bill doubles. The measurement tool itself is compromised. I'm not saying everyone who makes this argument is operating in bad faith. Many mainstream analysts are working with the tools they were trained with, looking at the metrics they have always looked at, doing what their MBA programs taught them to do. But in my analysis, those tools are increasingly insufficient for understanding where silver sits within the current structural shift. They are analyzing a 21st century supply crisis with 20th century models, and the people setting the Monday morning fake out are absolutely counting on those mainstream arguments being repeated widely enough to give cover to the move. They need the narrative support. They need people saying silver's overvalued while they're engineering the dip. It makes the dip look justified. And now let me answer the question I posed at the very beginning of this video, the question that frames everything. What happens to the price of silver if the people who are supposed to panic don't? Here is the answer, and it is the most important thing I will say in this entire video. When the stop hunt triggers on Monday morning, when that price dips into the $80 to $81 zone, The entire mechanism depends on a specific volume of physical metal entering the secondary market. Scared mid-tier stackers listing their coins, weak-handed futures longs getting stopped out, panicked calls to dealers asking for buyback quotes. That supply is what the short-side institutions need to cover their positions at favorable prices. It is the fuel the machine runs on. If that supply does not materialize, if the 100 to 500 ounce holders look at their screens, see the dip, remember this analysis, and hold, if they don't blink, the short-side players are in a genuinely difficult position. They are short silver contracts. They need physical metal at lower prices to cover. If the physical sellers do not show up, if the coins don't hit eBay, if the dealer phone lines stay quiet, they have to cover at higher prices. And when they cover at higher prices, they become buyers, which means the very force that pushed the price down becomes the force that pushes it back up, harder and faster. This is what a short squeeze looks like in a thinly traded physical market. It is not gradual, it is not orderly. It is a rapid, often violent repricing upward that leaves technical analysts scrambling to explain what happened. The shadow ladder I showed you, those call options stacked at $85, $87, $90, those positions make maximum sense if you know that a short squeeze is the likely resolution to the Monday fakeout. They're not betting on a slow grind higher. They're betting on a spike. So in my analysis, the answer to the question is this. If the mid-tier stackers hold, the fakeout fails, the short covering begins, the call options at higher strikes begin to print, and the price of silver on Tuesday or Wednesday looks nothing like the price on Monday morning. It doesn't crawl back. It explodes back. The entire setup is predicated on your panic. Your panic is the product they are trying to manufacture. Your fear is the commodity they are trading. And now that you can see the mechanism, now that you understand the playbook, you have a choice about whether to give it to them. You have agency. Use it. Let me close with something practical, something you can take into this week. If you are a 100 to 500 ounce silver holder, here are the specific things I would be watching this week. Not as financial advice, I cannot and will not give you that, but as an educational framework for interpreting what you see, for staying calm when the screen turns red. Watch the opening move. If silver opens this Monday with a sharp move toward or through $81, do not interpret that as the beginning of a new downtrend without first checking the volume behind it. Volume matters. A low-volume dip is a stop hunt, it's manufactured. A high-volume dip with sustained selling is a different signal entirely. That is real distribution. That is a different animal. Know the difference. Watch the recovery speed. If the price dips and then snaps back within 2 to 4 hours, that is consistent with the fake-out pattern we have discussed. That is the trap snapping shut on the wrong target. If it dips and stays down through the close of Monday's session, if it grinds lower into Tuesday, the picture is more complex, and we need to reassess. Watch dealer premiums. If spot price dips, but dealer premiums rise, meaning the gap between spot and what you pay at a dealer widens, that is one of the most powerful signals you can get, that physical demand is absorbing the paper price move rather than capitulating to it. That means the fake-out is failing at the physical level. That means the real market is calling BS on the paper market. Watch the options market. If you have access to tools that show you open interest changes in silver options, particularly at those $85, $87, $90 strikes, watch to see if additional positions are added on Monday. That would reinforce the shadow ladder thesis. That would tell you the big money is still positioned for upside. And most importantly, watch yourself. Notice if you feel the urge to do something, to sell, to call your dealer, to check the price every 15 minutes, to post in forums asking if you should be worried. That emotional response, that anxiety, that fear, that is the intended product of the setup. It is not a bug. It is the feature. Recognizing it gives you agency over it. Naming the feeling disarms it. That is the full picture for this Monday morning. Silver at $82, a fake-out likely targeting the $80 to $81 zone. A shadow ladder of call options quietly positioned above $85. A physical market sending signals that the paper price is disconnected from real supply and demand. And an institutional playbook that requires your panic to execute successfully. They need you. You do not need them. This has been Collapse Insight. If this analysis gave you a clearer picture of what you're looking at this week, if it gave you the framework to stay calm when others are panicking, share it with someone in your network who holds silver and may not have the context to interpret Monday's open without it. Drop your comment below, hold or empty. Let me know what you are seeing at the dealer level. Your input matters. This is a community intelligence project. And if you want to go deeper on the mechanics of the paper versus physical divide, the video in the top right walks through the COMEX delivery structure in detail. That is essential background for everything we covered today. It is the foundation under the foundation. This is for educational purposes only. Everything discussed here represents my own independent analysis and should not be construed as investment advice. I am not telling you what to do with your money. I am giving you tools to think clearly about what you're seeing. The decision, as always, is yours.